Portfolio return can be materially impacted by unintended risks that creep into a portfolio as a result of its security selection. Since risk factors drive majority of the return of equity securities, managing exposures to these factors becomes an important challenge. We can overcome this challenge by implementing factor exposure management as an integral part of the investment process. Today I'd like to show you how to analyze, define, and mitigate unwanted bets in your portfolio using Phaseinvest's plug-and-play technology. Let's see factor exposure management in action using a large cap developed Europe portfolio whose investment objective is deep value stocks with strong price momentum. Firstly, I will upload the portfolio using the copy-paste functionality, but I can also use a CSV file. I'll give it a name and assign it the type portfolio, select currency, and give it a series name real. We can assign multiple series for a portfolio, a feature we will visit a bit later. Now we will use factor analysis to analyze the exposure structure of our portfolio against its investment universe. This is because an investor always has the option to hold the market portfolio, but makes a conscious decision to deviate due to risk and return preferences. Now I'll choose the factors that I would like to analyze with the Phaseinvest tool. From the drop-down, I will choose the two factors from the value and momentum factor groups that align with my objectives. But I know that a value momentum portfolio can often result in negative exposures to size, quality, and riskiness. So I select factors from these three groups as well. And now I run the analysis. Within seconds, the analysis results are displayed. 5 cards that we see on the screen represent the 5 factors I have chosen. Each circle represents my portfolio and each of its segments its holdings. I can view the portfolio's exposure, percentile distribution, and its rating to each factor. Our portfolio exhibits strong positive exposures to both value and momentum, so we are aligned with our investment objective. But we see material negative exposures to size, quality, and riskiness. And these are the unintended bets that can impact portfolio return in an uncontrolled manner, with the manager unable to explain performance deviation from intended objectives. An exposure deviation of plus minus 0.25 standard deviations from the universe mean starts to become material. Please refer to our wiki for detailed explanation on interpreting our data analytics. Securities like Banco BPM, Investec, Kion Group, Subsea, and Pavag contribute materially to all three unintended bets. It is important to identify all such positions to assess whether our investment thesis for these selections is intact, or are they selections that might conceal a cognitive bias. We can dig deeper into each unintended bet by clicking this button on each card. Let's start with the size factor. We have transitioned to the details analysis, where we can analyze the portfolio exposure to a single factor in greater detail. We sort first by the most negative exposure rating, and then by the percentage contribution to the portfolio's factor exposure. Comparing the weight of the stock to its percentage contribution allows us to assess its impact. You can think of weight as the currency spent on the position and the percentage exposure contribution its impact. The combined weight of these 5 stocks is around 16%, but their exposure impact is closer to 29%, an outsized contribution. We now change the factor from the drop-down selector to the quality factor and click play. And we see that the combined impact of the 5 stocks is 19%. We now select the riskiness factor, click play, and see that their combined impact is 22%. If upon review, our investment thesis on each of these 5 stocks is shaky, we should switch them for suitable alternatives And this is risk management in the face of uncertainty. Every investment process has its own criteria for identifying suitable alternatives. It can be bottom-up stock picking or numeric score-based ranking. The process of mitigating exposures is the same. Unintended bets can be managed by completely switching out of securities or by altering their weights. The Phaseinvest platform allows you to perform simulation of studying the real-time effect on exposures due to switching of securities or reassignment of weights. We will see both actions in this example. Using the portfolio constructor workflow, I will select our value momentum portfolio as the initial portfolio so that we will always be able to view the existing holdings of the portfolio. And I'll select the developed Europe large cap benchmark as the source from which we will find viable alternatives. The factor values of the selected source for each factor determine the normalized exposure metric for each security. I select the currency, the 5 factors we wish to manage, and the date of the rebalancing. The initial portfolio is our starting point for the rebalanced portfolio, as we are going to make changes to existing positions. I select the portfolio holdings for our portfolio from the Assign Weights dropdown. The securities held in the portfolio have now been selected, and the weights and weight multiplier columns have been populated with the weight of each security held in the portfolio. In our illustration, we will find suitable alternatives that keep us aligned with value and momentum as our primary investment objectives, but mitigate the unintended bets to size, quality, and riskiness. We will take a sectoral approach to portfolio management, and we will switch securities and weights to alternatives within the same sector. Let's begin with financial services, where we have about 10.5% weight in unintended bets. We will swap Banco BPM for Deutsche Börse, Investec with Zurich Insurance, and allocate 2% of Bauer Group to EQT. The sum of the portfolio contribution column for each factor is the portfolio exposure to each factor, as we saw on the dashboard. As we can see, we've reduced the deviation of the unintended exposures from the universe, but maintained a positive exposure to value and momentum. We will take the same approach to find suitable alternative for Subsea, which is in the energy sector, and Kion Group, which is in the industrial sector. Eni is the suitable alternative for Subsea, and Airbus is the suitable alternative for Kion Group. With these 5 changes, we have significantly altered the exposures to these 3 factors. If we deem the rebalancing to be complete, because we feel we've moved the exposures significantly in magnitude and direction to where we want, we can save the rebalanced portfolio as a virtual series of the same portfolio. We had mentioned earlier that we will see this functionality later. So now we have a real portfolio and a simulated series that we can compare with each other for the same portfolio. We now compare the original portfolio with its rebalanced version against the investment universe. We can validate that our rebalanced portfolio is still very much aligned with our investment objective, but we have significantly reduced the size of our unintended bets. We have systematically managed exposures to 5 risk dimensions in a few easy steps. We began with a portfolio aligned with its investment objectives, but with hidden unintended bets. We've mitigated potential cognitive bias in our selections using an objective, data-driven process. In summary, a disciplined approach to managing factor exposures can help investors navigate uncertain markets and capture opportunities. Phaseinvest's affordable plug-and-play technology improves equity investing by simplifying the management of equity risk factors. For more information, please book a one-to-one meeting using our Calendly link or register for a 14-day no-cost trial. Both links are provided in the text below. Thank you very much for your time.